Investment Crowdfunding Unlocked. Raising capital and building wealth together. How ordinary people and entrepreneurs are rewriting the wealth building playbook. Stay tuned. Thank you for joining me today. I'm Madelyn Blair, and this is Unlocked, a show all about unlocking the resilient leader in you. And if you like this show and you like what we do, support us. The free, simple way to do that is to hit the thumbs up and the subscribe button. I am committed to doing everything I can to make this show better every week. Thank you so much. You know, I always thought of crowdfunding as GoFundMe. There are other names, but I think you know what I mean. To me, it has always been about sending an artist or an inventor some money so that they can produce what they dream of. In one case, I sent an artist in Italy the top amount that she was asking for. It was like a little bit over $200. On her part, she promised to send me one of her pieces. Today, that amazing piece still hangs on a featured wall in my home. Here is a picture of it. It's called a blossom blanket and is made of thick, pure cashmere. Another time, I sent a small amount of money to someone who had an idea for creating solar lights in a small box that could give hours of light for those who live without electricity. At the time, there was very little known about solar energy or its applications. Today, small solar lights are an entire industry. My ideas about crowdfunding as GoFundMe and nothing more changed when I went to a virtual conference and listened to today's guest, Yvan de Munck. He is the investment crowdfunding expert, a FinTech strategist and brand builder behind RegCF Rocket. He helps founders raise millions and empowers everyday investors to build startup wealth. When I listened to him at the conference, I heard someone who could put complex concepts into English. Let me bring him on. Yvan, welcome to Unlocked.
Hey, Madelyn. Nice to meet you, and thanks for having me on.
Oh, you are so welcome. Well, I want to get into why you've done this. I mean, you spent 20 years on Wall Street in finance and fintech, and even holding FINRA licenses and advising on lending and crypto before dedicating yourself to online capital formation. Now you're a champion of fintech and crowdfunding. Tell my audience what fintech and crowdfunding is and what inspired you to pivot from conventional finance to this form.
Yeah, thanks for the question. I mean, it's two different concepts, right? Fintech is really sort of the combination of finance and technology, and basically started 20, 25 years ago when, after the great financial crisis, like 2008, 2009, and people said, look, classic finance brings us problem. Are there other, better ways to do things? And that's where certain companies, we call them now fintech companies, primarily also tech software companies, were looking for ways to, do some of what banking is doing, but better, faster, and cheaper. I always call it the BFC factor, right? Better, faster, cheaper. And so we had these companies come up that, do some of the lending stuff better. They do some of the deposit better, and they did it, without branches. We had virtual banks start, right? And they could obviously, because they had no huge marketing costs or no banking branches, they could offer, better rates on your deposits, or they could, present you cheaper loans. So that's basically what fintech is all about. The way that crowdfunding plays into this whole thing is that also, after 2008, 2009, you had these platforms in the classic crowdfunding sense, names like, Indiegogo and Kickstarter. They started at that time, and they said, look, we want to try these marketplaces where people can go and, get some money from friends and family to fund something that I'm passionate about and give them a present in return, or sort of, they can donate to a good cause. And so an interesting concept, which is still today there, and which is what most people associate crowdfunding with. What most people don't understand is that there is another part of crowdfunding, which is called investment crowdfunding. It's primarily equity crowdfunding, but it's basically giving people the opportunity to buy into, pieces of the equity of early stage and small companies. And so where my idea came from is that after my career on Wall Street, which was around 2010, 2011, when I was running an equity sales and trading desk. So I was selling European equities to U.S. institutions. But in the last couple of years, I had a friend of mine, a neighbor, who actually introduced me to the co-founder of Lending Club. And Lending Club was one of these early, platforms that actually did this crowdfunding idea, but for consumer loans. And so they had these platforms where actually you could go and ask for a loan, let's say $5,000 or $10,000 to do your kitchen, whatever. And on the other side, you had people who were interested to buy pieces of that loan. And that became a concept called peer-to-peer lending. And so that's where it all started for me. While I was doing my daily equity trading and sales business, I opened an account on Lending Club on that platform. That was long before they were sort of a public company. And so I started buying these little pieces of an unsecured consumer loans, which sounds very risky, but you were buying small portions of, in a broad portfolio of these loans. And lo and behold, a couple of years in, I was, seeing returns of 9 to 11% in these consumer loans without having to do anything, just buying some pieces every month, every week, whatever. And I said, well, this is great. And that's where really I wanted to go into that space. I said, look, Wall Street, that's over for me. I've seen it. It's boring. I want to do something else. I was very excited by that. And that was my first sort of introduction into the crowdfunding space through this peer-to-peer online lending, sort of experience, which really was the first iteration of what today is called investment crowdfunding.
I don't think I've ever heard anybody say that finance and Wall Street gets boring. And I'm really happy to hear that.
No, it is. Now more than ever, but it really is boring. It's all computerized right now. There's no fun anymore.
No fun anymore. Okay. Well, given that, why should somebody invest in what you called, I think, this asset class? And talk about why we use that term, asset class.
Yeah, and before I get there, let me step a little bit back on how I go from sort of, these pieces of consumer loans to actually, sort of buying pieces of
Sure.
early stage businesses today. So, I was part of the first investment manager back in 2010 who we launched a fund called Eaglewood, and it would become the first institutional manager to invest large amounts of capital into this newly investable asset class, meaning unsecured consumer credit, right? And so it's an asset class which is great, gives you these return, 10-ish, low single, low double-digit returns, or high single, low double-digit returns. And so as I went through that evolution, the fund did very well, was sold to another asset manager in Europe. And then I went to work for a number of FinTech companies, also in tech, a lot of them related to AI, but a lot of them always concentrated on this, consumer credit space. And so what was frustrating for me is that, at times I tried to get equities in these business because I was a very early player in these companies. And for a number of reasons, this thing didn't really play out. But I saw these companies actually exiting at, sizable exit values. And I didn't get the full upside of these things. And I said, wait a minute. Why isn't it possible to, because I know the asset class is basically venture capital, right? Venture capital, that's what we're talking about here, is investing in very early stage companies. And I said, look, I'm convinced, it's not convinced, the data show that venture capital as an asset class is the best returning asset class of all, together with private equity it beats every other investment. So that's the first reason why I want to invest in there. You're looking at high teens, low 20s type of return over the mid to longer term in the asset class. That's just the data.
Now, why is that so?
Well, it's very simple. High risk, high reward. If you invest in very early stage small companies, right, it's very risky. In and of itself, it's very risky. But if you do it well and you know what you're doing and you do it in an aggregated way, in a portfolio way, in a diversified way, because that's the whole thing, over a longer period of time, that's where the numbers come in. That's how it works. That's how it works. And that's why most people in the stock market, real retail investors, are on average very bad investors. They always buy at the high and sell at the low. I mean, that's just how it is. All the data shows that. So the ones who really make money, all the intermediaries, the stockbrokers, right, and the asset managers. So that's why if you invest in stock markets, the best way to do it has always been proven. Active management doesn't work. You just buy the cheapest ETF out there. You buy the market, and you're going to be fine. That's what everybody should be doing, right? So, but here, if you really want to make sizable returns, much more than the average, you go in early and you buy a basket of very early stage companies because, again, history has shown this is, by definition, it's high risk, but over time, you're going to have higher rewards. That's just how it works.
So how does somebody navigate in this arena with, how do you navigate in this?
Well, that's the other thing. And that's why, again, investment crowdfunding is so exciting and poised for massive growth going forward, because there's a lot of, underlying trends that are working towards this asset class becoming very interesting also for a younger generation who has a tough time building any wealth at all. Yeah. So up until now, until recently, before this industry actually existed, I mean, the only people who can participate in these deals, in this early stage stuff and capture that upside of that return for the asset class is rich people, right? Or accredited people or very affluent people, right? Because they get access to the good stuff. They get access to deals that nobody else can get access to, right? If you're really rich, then obviously it's all the friends, it's all among, you're never going to see anything, right? As a normal person like you and I. But even with accredited people, there's certain offerings in the market that are only accessible for accredited people. And obviously they're trying to change that definition, but still you need to make $200,000 or $300,000 a year, or you have to have 1 million net worth. And, that's not everybody, right? That's not most people. So how can you as a normal person get access to that opportunity? And that's where investment crowdfunding. So it's the only place where, as a normal person with a small budget, you can allocate to this asset class in a very determined, systematic way and build a portfolio, even with small amounts of money, but get these returns over time, which again, around to 20% a year, which is great returns. And if you do it well over time and you know what you're doing and you work with the right data and you put some AI in there, and we'll come to that in a moment, then you might very well happen to have one of the outliers in your portfolio. Because one of the other things in venture capital, very important to understand, venture capital is not a game of averages. It's a game of outliers.
Yes.
So you want
an
outliers.
For our audience, an outlier is when it's just way off the charts.
Correct. So instead, I talked about averages for the asset class, right? About 20%. Averages is the stock is going to give you 100%, 150 or 200% or 300%, right? And they're out there, right? But in order to be able to have the opportunity to potentially have one of these companies in your portfolio, you need to, I always say, you got to be in it to win it. You got to be in the market. You got to take action. Without taking action, it's not going to happen. But now you have a system and you have a regulatory environment where normal people with $1,000 can start. With $10,000, you can put a portfolio of 20, 25 companies together. And over time, at least have the average, because that's what it's going to give you. In a worst case, a little bit less, but in the best case, you're going to have 25, 30, 35, 40% return. And it's only with a small part of your portfolio anyway. So everybody should be doing this. Everybody.
I'm so appreciative that you use that term, that word, 1,000.
Yeah.
I mean, if you can begin at 1,000, I mean, not everybody can. I understand that.
You can begin at 100. Most of these offerings
Even
today,
better.
you can begin at $100. Okay. Here and there, it's like $200, $300, depending on what kind of company and how successful they are. Most of these companies start at $100. So with $100, you can own the piece of the equity of a very exciting early stage startup. And you can do this tomorrow. It's not difficult. And I have a course, by the way, that tells you exactly how to do it, but it's very simple.
What's the name of your course?
Unlock Startup Wealth.
I love the word unlock.
There you go.
So you see, everybody, it's a great word. Yeah. Now applied in a new way.
Yeah.
But are there mistakes that should be avoided when we do this?
Well, yes, of course. It's first of all, you gotta know about the sort of the background of the industry, where we come from, what the numbers are so far. Next year we're going to celebrate 10 years of existence of this industry. So it's still a pretty young industry after all. Yeah. And if you look at the numbers in the grand scheme of things, I have all the numbers here, but it's so it's part of the legislation that was started in 2012. It's part of the Jobs Act. And actually my partners at Crowdfund Capital Advisors is a team actually that wrote the legislative framework for what became Title III in the Jobs Act in 2012, which was signed by President Obama. And that basically created that industry, right? But it took another 4 years before the first deal actually came to the market. That was in May 2016. So next year in May 26, we'll have 10 years of existence. So we have all the data. So what I do at CClear is a subsidiary of Crowdfund Capital Advisors. It's a data analytics company. So what we've done over all this period, we have scrutinized every single offering from day one, which is May 2016, up until today. And that's what we do. And we look at all the details of every single deal that becomes public, where you can invest. And so we've been able to analyze and really see what are the KPIs, what are the key success factors of the companies that actually do well over time. And we've developed an algorithm from there. So, but just looking at the statistics. So today, we have about just north of $3 billion has been invested in these companies over the last 9 something years, right? So if I look at some of the other stats here, we have more than 8,100 companies that have been funded, right? So there might be 8,000 companies that may not have existed if they didn't have this avenue to be funded, right? It created, there were more than 2.1 million individual investments that were made by retail investors, primarily in these deals. It created directly 430,000 jobs by these companies for a total of about close to $15 billion in enterprise value that was created, and more than $27 billion of economic stimulus, indirect, by all these companies that were created. And so, enormous, economic impact, but still very small. 3 billion in the grand scheme of things these days. They talk about 100 billions every day, everywhere, right? And trillions. It's nothing anymore these days. 3 billion is nothing.
As you're talking about that, I'm thinking to myself, I remember when this was beginning myself, and I remember doing statistics that showed that it was the small companies that really created jobs, and that we always talk about the big companies and the number of jobs that they have, but in fact, it's the many, many, many small companies in this country that makes for a really robust labor market. And that's what I'm hearing from you too.
Oh yeah, and that's one of the other things. I mean, all these big companies, now they're laying off thousands of people, right? You got AI coming in, all the big tech companies, they're making more money than ever, but they're firing more people than ever, right? So the companies that are really creating the economy, that are providing the jobs, are these small and medium-sized companies. That's the the backbone of this economy. And if we want to continue to survive as an economy and grow, these are the companies that have to make it happen. It's not going to come from the big companies. They don't care, right? They don't care.
Yeah,
they really don't.
Yeah, because when you start your company, you care about everything.
Yes. And so my contention is that, and I've done some calculations and some work, and you can find it out on some of the websites that I'm working on. But I see this industry explode. Actually, I should go back to my mission, right? So my mission is really to have 1% of Americans invest at least $1,000 a year for the next 4 years, so we can take this industry from the current 3 billion to 16 billion plus by the end of this administration, at which point institutional capital is going to come in and is going to scale it to 50 billion plus by 2035, right? So that's my mission. And the reason why I know this is going to happen is because I go back to my past. I've seen this movie before. I go back to my peer-to-peer lending days, right? So in 2012, when we launched the first fund to have institutional capital coming into this online, lending space, basically, online lending didn't exist. If you needed an unsecured consumer loan, you had to go to the bank, right? You had to go to the branch, talk to the guy, talk for weeks and months and whatever. Horrible experience. It's still a horrible experience, right? Just because you wanted $10,000 to do your kitchen, right? Okay, horrible experience. But there was no online marketplace. So that changed when names like Prosper and Lending Club came up and created these marketplaces where buyers and sellers of these loans came together. Today, so we went from basically banks having 100% of that market. Today, less than 50% of the market is done by banks, and they continue to lose market share. And all these loans today, if you want a loan tomorrow to do your kitchen, right? You type in Google or whatever, right? They said, I want $15,000 to do my kitchen. Well, what you're going to get, you're going to get a list of 10 or 15 financial institutions, but they're not going to be banks. They're going to be a lending club. They're going to be a Prosper. It's going to be SoFi. It's going to be whatever other name is in there, where you can basically have a loan, apply for it, and literally tomorrow have the money in your bank, right? So that became from an industry that was non-existing to today a multi-trillion-dollar industry. Today, online consumer loans are being issued by the tens of billions every single week, every single month, being packaged, securitized by big institutions. So it's a massive asset class. The frustration is, as a retail investor, you can't participate anymore. So all the good stuff is gone. You can't. So what I was doing 10 years ago, you can't do that today anymore. That's gone. So that's why I'm saying exactly the same thing is going to happen with investment crowdfunding. But instead of small pieces of a consumer loan, you're going to be buying small pieces of the equity of small startup businesses. And that's much more exciting because there's much more upside, right? With credit, you're limited to 9, 10, 11%, 12%, whatever. But it's like, that's what it is. With equities, obviously, the upside is potentially massive. But again, the average is at least high teens, low 20s, which is still already the greatest asset class that's out there. So you want to have exposure. You absolutely want to have exposure. And this is the only way you can get it as a retail investor today. And nobody knows about it, really.
No, and nobody's talking about it.
I am. We are. Yeah. But it's going to change. Trust me, it's going to change. A lot of things are going to change in the next few years.
It feels like it is, almost like on a tipping point.
And also because some trends in society, right? It's this younger generation, again, that feels increasingly being left out. They see all these gazillions and trillionaires and whatnot. And it's like, and in the meantime, they can't buy a house. They can start a family. You have to pay like, $100,000 to go to college and whatever. And in the meantime, they have to think about, how am I going to build wealth for me later or for my kids or whatever? Right. This is the only way. They think, we're going to buy crypto. Okay, but that's a different story. But that's not really investing. That's speculating. It's different, right? Mm-hmm. But I do believe you need to own some Bitcoin in your portfolio, but that's a different story. You really want to participate in entrepreneurial America. And that's what you do by investing in small businesses.
This reminds me so much of my early studies. I mean, I went to Wharton many, many years ago. And we talked about this, and it was always the idea that the company was a person who had an idea, and that they gathered people and resources so that they could then produce whatever they wanted to. But there was always this idea that it was a person who wanted to create something, and it became in a way lost when there was so much money involved. That people forgot that their job was that they wanted to produce something rather than just make more money. And as I'm hearing you, it really makes my mind go back, because these are small companies and they're still in that place where they're close to their dream.
Again, there's a lot of ground we can cover here, but there's another concept that is very important that's part of that sort of narrative, is what friends of mine and colleagues as well call investomers or insumers. It's a combination of investors that are becoming your customers, or your customers becoming investors. It's that one-on-one relationship. If you invest in these companies, these CEOs, these founders, they know you by name.
Yeah.
They reach out to you. They're going to be excited. They're going to keep you posted on what they're doing. They're going to, and it's exactly what you're saying. You're going to care about what these companies are. You're going to follow them up. You're going to see, okay, I gave you $1,000. 18 months from now, they're going to come back to the market. They're going to do for a second round or a third round. And they say, okay, well, you said you were going to do this. What have you produced? What did you do? Well, we did. These are our milestones. This is what we said we were doing with your money. This is what we did. Now we need more money to do the next step. And they say, oh, that's great. I'm going to give you a little bit more. I'm going to give you a little bit more. So that's how, but you have a connection with these companies. Yeah. And if you own these pieces of companies, again, small, early stage, and in all sectors, biotech, tech, retail, breweries, you have all these kind of companies, you're going to be personally really invested. And what's going to happen is that you become a champion. That's the concept. You become a champion for all these companies. And you're going to talk to all your friends and family about, hey, you know what? I invested in this company. You have to look at these guys because they're doing really well. I own a piece of the business. You can own a piece too. You know what? You can start with $500 or $100. It's really exciting. You have a vested interest. And these companies are going to come to you and treat you as a person, right? Yeah. And it's so exciting. And then you have the occasional outliers, right? Which now increasingly, because there is a period between these early fundings and eventual exits, right? Typically, it's in the best case, it's 3 to 5 years, but sometimes the numbers show it. The longer you hold these things, the higher your potential for outliers is going to, be. So sometimes you have to wait 7, 8, 9 years for an exit. But then, for instance, today you have a company called Boxable, which is one of these companies that 5 or 6 years ago went to first crowdfunding round. And now is one of the big exits, is about to go public on the NASDAQ through a SPAC transaction. And the earliest investors who invested, again, maybe $100 on day one with this company, and they're doing fantastic product, by the way, it's housing related. They're going to make 85 times their money, 85 times, right? Mm-hmm. One example, there are others, it's not 85, but you have a lot to do 20, 30, or 40 times their money, right? But you got to wait 3, 4, 5 years before that happens. But that's exciting because you can say, hey, I was one of these guys and I make a big killing there. Yeah. Right? That's fantastic.
And we were talking earlier about the young people and the fact that they can't do what those of us perhaps in our generation were able to do.
And that's the thing. So, and sorry to cut you off there, but I was thinking about something. So today, all these younger people, when they have the chance to have a job and they have a 401k or an IRA, typically you're going to put a little bit of your money every month into, right, a couple of $100 in your 401k or whatever. I'm not saying that's bad, but why not take a part of that, and instead of taking it into a fund, which is all fees on fees on fees. These are all passive funds. As I told you, I mean, the people who are rich from this industry are all the intermediaries. It's not you, right? It's not you. So much better just don't do that. Put your money in the cheapest ETF, buy the market on one side of the thing, and then take more risk with a small part of that allocation. Let's say 5% of your portfolio, of your paycheck, or 10% of your paycheck, 5% goes into an ETF, and then 5% goes into investment crowdfunding. And every month you buy a couple of companies and you buy more of a couple of companies. And next thing you know, you have a portfolio of 25 companies. You hold these for 3, 5, 7 years. Oh, you're going to do well. You're going to do very well.
But what I was driving at was the fact that they are young people and they have those years to wait.
They do.
They really have those years to wait. I'll never forget one of my early jobs. I was at a university. And so at universities, they always put money into TIAA CREF.
Sure.
That's the retirement thing. Well, after I left university, I forgot about it. And 20 years later, it had grown 85 times. and it was just a question of time. So I love the fact that you remind people you just have to wait a little bit.
Well, or also longer. The problem is you don't, and that's the beauty as well. People say, but it's illiquid. Thank God it's illiquid. That's the other thing. It's not really illiquid. We can talk about that, but that's a good thing, because as I told you before, in retail, investors are bad investors. Typically in the markets, they're going to buy at the highest and they're going to sell at the lowest. And on average, they don't make returns, they lose money, right? The only ones who get better are the intermediaries. So the fact that it's illiquid, it's great. So you can't do anything with it. You have to wait anywhere until something happens. So you go to good times, bad times.
Yeah.
But again, over time, you're going to have those averages, right? And
I like the fact that it can be a very small amount of money, because
it has to be. It has to be, because it's regulated, and you have limits on what you can invest. So for retail investors, you can invest only, I think it's about $2,400 a year, or a percentage of your net income. So it's really regulated. So you can't even, if you want to do $50,000, you can't.
Yeah. Okay.
It's limited.
I want to flip it now. A lot of my audience they're in their careers.
Sure.
And maybe they're looking to retirement, or maybe they're saying, it's time for me to pivot. How can they use these concepts, this new asset form, to maybe create their own company or their own idea? And they become, in other words, become the founder of something.
Yes. So you're asking really about how can they use this industry to raise capital for their own.
Right.
Right. Okay. So that's these are marketplaces with two sides, right? You have the investment side, which is exciting, which we talked about. And then you have the other side, which also is equally exciting for a number of reasons. Increasingly, more and more people, again, it's a kind of generational thing, but we have a massive, after COVID, we have a massive increase of people who are starting businesses. Sometimes out of necessity, because they're being fired or whatever, or they need more money, or they just are fed up with everything and say, look, I have an idea, and I think I can find some more people who can back this idea. And typically, if you start something, you do it with, friends and family money, right? Or your credit card, whatever. But that's limited. So if you have something that really looks cool and you have people who are excited about it, and you say, hey, this has legs, you want to go and raise capital, additional capital. And then you can forget about banks, because they don't fund anything that's younger than 3 years, and you need financial statements. So that's not for banks. VCs has been, the volume there's been driving down for the last couple of years. They're only interested in huge amounts of deals, huge tickets, right? Because there's so much money they have. For them, it doesn't pay to, sort of invest a few $1 million in something. It doesn't move the needle. So more and more of that opportunity is gone. And then the only thing that's left is sort of, angel investors, right? Or high net worth people. But again, it's very laborious to go and find all these people. It's a lot of work. You don't have a network. It's again, you got to work through intermediaries that you have to pay in order to go and find these people. So now with investment crowdfunding, you can pitch your business to any of these platforms that will list you. Now, it's a very competitive world out there. So you have literally every day thousands of companies that are trying to raise capital through the classic means, but also through investment crowdfunding. And so that's where the idea of the funnel comes into play, right? So from all these thousands of companies that are pitching themselves to be selected by one of these platforms, these regulated platforms that are listing these deals, there are only a select number that are being selected, and it's a small percentage. Which makes sense, because these platforms, obviously, they want to make sure before they list something on their platform, these platforms are like, WeFunder or Dealmaker or Republic, some of these names, they want to make sure that the deal is, on the face of it, a good deal and likely to be successful, right? Or likely to be able to raise the money that they want to raise. So they do a curation, right? They curate these deals. And so from the thousands that are out there, only a limited amount of them will be listed on a daily basis, right? But it still means that on a daily basis, if I want to go and invest today and I look what's out there, you have a few hundreds of companies, 400 to 500 companies to choose from every single day to invest. But again, we're on the investment side here. You want to be on the issuer side. So you want to position yourself to pitch yourself as best as you can to be selected by one of these platforms. So the way you do that is obviously you got to do your homework. And one of the services that we offer, and I've been active in a company that was doing that, a company called Informa. It's called competitive benchmarking, right? And that's very important. You're gonna have to spend some money in order to work on your marketing, right, and your pitch and whatnot. And so what we do, we have a service called Offering Insights Report. And that is really for anybody who wants to start a business and has something going and is looking to raise capital using this regulation. They can sign up for the report. I think it's about $400 or something like this. And we then run it through our system. We use everything we know from all the offerings in the past, and that's where the AI and machine learning comes in, right? We do competitive benchmarking. So we're going to analyze, how does your business compare to all the other businesses that came before you that have a similar kind of business, and how did they do it in the market? Were they able to raise capital, and if so, how much and at what price, and all these kind of things. And then we compare you versus all the other ones, and we say, look, and we're going to advise you and say, look, you're wrong here, or you're badly positioned here. You got to change this and you got to change that in order to position yourself the best you can, in order to make the best chance to be selected to come on one of these platforms. So that's the way we work, and that's, I think, the way every company should look at this, because a lot of companies try and don't get selected, and they wonder why. Well, if afterwards I talk to them, so it's obvious. I'll give you one example. In these platforms, if you want to get listed, you got to determine yourself how much you think your company is worth, right? If you go to a VC and you raise capital, the VC is going to tell you how much you're worth, right? You're going to say, well, you're going to raise $5 million at a $50 million valuation. I'm just throwing out a number. They're going to tell you your value is 15 million, and I give you 5 million. Okay, fine. Take it or leave it. In investment crowdfunding, you have to go to this platform and say, well, my company is worth X. 15. Say your company is worth 15 million, and I want to raise 5 million. Then we're going to tell you, okay, we're going to look in our competitive benchmarking in this report, and we're going to find out maybe, hey, wait a minute, all the other companies that have a similar profile to yours in the same industry over the last 9.5 years, they all had an average valuation of 12 million, not 15. So you're way out of line with your valuation. And then you can do two things. And it goes, well, no, I want 15. Then we can say, okay, you can try 15, but then your chances of being selected for one of these platforms is maybe much lower. Or if you do get selected, there's a high chance that nobody's going to buy into your company, because they're all going to go look in the past and going to see, okay, what did similar companies do in the past? What was their valuation? And if you think you're worth 15, but I think you're worth 11 or 12, what's the reason why you think it's 15, right? And if you're way off the mark, then you're not going to get funded. People aren't going to give you money. Okay. So that's why competitive benchmark is so important. And we have the numbers, you have the data, so you can find the information.
Well, what if you are just beginning? You have no valuation. You have an idea.
Then you don't do crowdfunding. You don't. You need to have something. You need to even, you don't necessarily need to be revenue generating, but you need to have something that shows that there is a traction, that there is an interest. I give you one other example. It's actually working very well in investment crowdfunding. It's the biotech industry. There's a lot of biotech there that gets financed, and not medtech with hardware, but really biotech. And that's all about IP. There's, for instance, a PhD, a doctor who has a certain ID or certain IP around a certain therapy for a certain disease that is pretty unique. It's never going to be funded by big pharma because it's way too small, but it's a very specific disease where only 10,000 Americans suffer every single year. But that person has suffered from it, and she has the IP on a treatment for that particular disease. So she wants to raise capital, let's say $1 million or $500,000 in order to fund a first, research effort, right? Or a test or something like this. No revenue, no nothing, just the idea, just the IP. A lot of these companies get funded very successfully. Why? Because that person with that particular disease, there are maybe 50,000 other Americans who have the same disease, who think it's very exciting that there is this one person who's actually going to try to do something about it, has this idea, has this IP about a certain therapy, and they're very willing to give a couple of $100, right, to this person to start a company and try to make something out of it. And we have huge successes over the last, again, 9.5 years since the existing of the industry of biotech companies that started from absolutely nothing and now are big companies that in the meantime had exits, were bought out by big pharma and made millions for their investors.
Yeah.
So but if you have nothing, just an idea, and no, that's not going to work. You really have to, pre-fund yourself. You can always try, but I think the chances are, if there is not enough meat on the bone there, something to work with, you're first of all not going to be selected by any of the platforms, most probably. And if you are, then there is a high likelihood that you're going to fail in your campaign, which happens, right? If you say,
I think that's the real issue, that you won't get any money, basically, in this.
Yeah, and it's not the end of the world, but it's a failed campaign. You're going to have spend money and time,
right?
And it's not going to work. And maybe you're gonna raise $10,000 where your goal was $500,000. Okay, so what are you going to do? It's not really, and that's bad. It's really bad. It's not helpful.
Now, earlier you said that we're about to celebrate 10 years of this.
Not me, the industry.
The industry.
Yes.
I'm sorry. To me, though, that still feels new because I never heard of it. A lot of times when you see new things in the marketplace, it's kind of like the Wild West. Everybody wants to do it their way, etc. And it can lead you in very difficult and unhealthy situations. Is crowdfunding theirs, or has it resolved enough? We just have to, as consumers, understand it and just get in the market.
Good question. But I have a few different observations there. Again, I go back to history. Peer-to-peer lending, 2008, 2009. Everybody at the time told me, or the industry said, who on earth is going to ever give money to a stranger for a loan, right? In an unsecured consumer loan, meaning there is no asset backed, right? There is no guarantee that I'm going to see any. Who's doing that, right? You go from a situation where everybody thought that was crazy, lending online to strangers you don't know, from people you don't know, to a multi-trillion-dollar industry today, which is completely mature and taken over by institutions and is a highly regarded and well-returning asset class, right? But again, retail is out. But in the meantime, and that's just, 15 years, right? Same thing happened there from nothing, and everybody thought it was a laughing stock. I go back to crypto as well, if you want. Bitcoin, right? Who thought in the beginning Bitcoin? It's a joke. All the bankers, everybody in the world, is the biggest scam in the world. And now, today, every single bank, even JP Morgan, right, with Jimmy Dimon, who said it's an absolute, joke, and everybody who tries to do anything there is going to be fired, to today, this bank being involved like all over. Every single institution is now into blockchain, into Bitcoin, into crypto, everywhere. That's just 10 years ago, right? So in the beginning, what seems completely strange and weird and it's not going to work, if you really do the work and you really think through the whole thing, and you know where it's going, because I've seen the movie before. And here we're much further. This is not the Wild West anymore. It's a very regulated industry. That's the big difference as well. That's why, my brand is called RegCF Rocket. It's RegCF stands for Regulation Crowdfunding. It's part of the Jobs Act of 2012, which was the last big act that actually was voted with a huge bipartisan majority, which we don't have anymore, but at the time, massive. So, and it's a legislation, it's there and it continues to grow. It's just not being promoted that much because, again, it's not big enough. So big money is not interested. So the media is not interested. Big money is not interested because it's too small. But that's why it's so interested. If you're small, that's why when nobody pays attention, that's when you want to pay attention.
Yeah.
Right? That's what it is. That's what it is. I give you one example. Again, it's like I bought Bitcoin at $245 and I sold it at $450. And I thought I was a great trader. I never bought back in, and today we're like $115,000, okay, for one Bitcoin. So yeah, you want to be in this because it's early. Because in 5 years from now or 10 years from now, It's going to be so institutionalized. Big money is going to take it over. It's going to be, productized, and you're going to be out, and all the upside is going to be gone, and all the intermediaries are going to profit from it.
So key is stay under the radar.
Yeah, and that's why I'm so excited about it. But I want to make sure that as many people as possible know about this and start looking at this and get the information and get the data, because it's all about data as well, right?
Yeah. I think I could go on with this conversation, but we have almost run out of time. But I want to ask you, are there some closing comments that you would like to make to the audience about this, what I consider to be very exciting?
Well, first of all, you should be very excited about this opportunity. So there are ways to get involved. Obviously, following people like me on my channel. I'm primarily active these days on YouTube. So go to YouTube, type in RecCF Rocket, and you'll find all my videos where, on a daily basis, I have 2 or 3 little clips, 5-6 minutes long, that really talk about many things around venture capital, around the changes in how companies get funded, and changes how, wealth is being created through investing early in early stage companies. So I think you should definitely, follow that. And I'll send you some links later on as well regarding some of the products that we offer. But I think what is very important is the 2 reports that we produce at CClear, which is one, the Offering Insights report, which we talked about. That's for people who are looking to raise money using this legislation, right? It's the Offering Insights report, which can be ordered online, and it's very simple, very straightforward. But I think it's a key element that every company should buy before they're going to try to raise money. And on the other side, and I'll finish with that, is we produced a report, pretty new as well. And let me see what today's copy here. It's once a week. We produce something called Capital Pulse Ratings List. So I talked about my funnel before. So if you want to, it's very simple. If you want to get involved today, first thing you need to do is to get my course, Unlock Startup Wealth, and I send you the link later, right? 60-minute introduction. In one afternoon, you can sit it through. It's 6 small lessons. These tell you what it is, why you want to be involved, where to look at, and how to take action. Very simple. So you can be up and running tomorrow. You can start investing tomorrow, right? But the idea is with this report, so every week, here, like this, here you go, Capital Pulse reports. It's the only thing I use. So every day, if you want to invest today, as I told you before, there are hundreds of opportunities still out there, right? You have to choose between 400 or 500 open deals that are out there ready for it. They will take your investment. So where do you start? Well, you can sign up for all these platforms, and then you get an email once a week, and every one of these platforms say, "Oh, here are our 30 deals, the best of the best." And the other platforms say, "Oh, these are 50 deals, they're open, these are the best of the best." That doesn't help you. Capital Pulse Ratings Report this year gives you every week the top 15 open offerings as selected by CClear, which is based on our proprietary algorithm that we've developed, and that has proven to be very predictive of future success. Good. Right? So now you only have 15 companies to look at. And by the way, every week you don't have 15 new names. It's like this week, I only have 2 new names. So the only thing I do is look at my list, which are the new names. Then you have the companies that you want to look at. They're really the only ones you want to care about. And then you come on the last part, and that's where my custom GPT comes into play. You want to do the due diligence, right? These are not buy or sell ratings. These are just ratings that look, these are the best companies that you should look at right now that are open for investment. Now you got to start to do your due diligence. And due diligence, you can do it in detail, your own way, or you can go to something called RecCF Rocket GPT, which is my own GPT, which I've developed. You just put in the link of the company, the link of the offering page, and you'll see it on the page. And then it starts thinking. It's based on all the data that we have in there as well. And it will give you a very detailed, 5-page report with the basic due diligence on this company, with all the pros and cons, everything you need to know that you would do in a normal due diligence. And with all that, then you can say, okay, it's the right time, great company, due diligence looks fine. Great, gonna put some money at work, put $500 in there. And so that's the last part of the equation. If you do that, then I think you're very well positioned to be active in the space and really capture the full upside over time of whatever you're doing in this industry.
Yvan de Munck, Thank you.
You're very welcome.
Every now and then, there is something that changes how I think about the world. Grounds for Thought is a place where I talk about these moments so that you can explore the meaning for yourself.
Yvan de Munck has given me so much to think about. Crowdsourcing has grown up. It is now investment crowdsourcing. While it was fun to contribute to artists and inventors, as I described in my opening, actually it still is. But now I understand that I can contribute to the equity of a company. I can become one of the owners of the company. All I had to do was take a look at the statistics to see that this is real. Since 2016, $3 billion were invested in 8,100 companies that used crowdfunding. Monies that came from 2.1 million individual investors, creating 430,000 new jobs. And the enterprise value of these companies has grown to $15 billion. Remember, on a $3 billion investment, while being also a $27 billion economic stimulus. Looking at it from the investor's perspective, the returns can come in 3 to 5 years or longer to not like 9 years. Across the industry, returns have averaged, according to Munck, out in the high teens and low 20s. By average, that is. That's real return. It also confirmed to me that small and medium-sized companies are where job creation happens. I remember when I was starting my business 37 years ago, job creation was one of the greatest incentives for supporting small to medium-sized companies. They continue to be the job creation location. While investment crowdfunding is almost 10 years old, it is still small enough that the institutional investors ignore it. Now, when you deal in billions and billions, $100 investment in crowdfunding doesn't entice them to come in to take their commissions for transactions. The good news is that means the increases in value. The good news is that means the increases in value that you achieve are all yours. This gives young people a way to begin to build wealth for themselves and from small investments. Liquid assets are ones you can turn into cash. This gives young people a way to begin to build wealth for themselves from small investments. Now, liquid assets are ones you can turn into cash at any time and do it quickly. Investment crowdfunding is called illiquid assets. That means that you can't turn it into cash quickly or easily. With investment crowdfunding, you're buying shares in a private company. There isn't a public market waiting to buy them tomorrow. However, shares can be listed on an alternative trading system, ATS, after just 1 year. So if liquidity is of prime concern to you, then this is not for you. But if not, it is a way for those who don't have thousands and millions to invest to be able to build wealth for themselves with small investments. The flip side of investing is asking others to invest in you. Consider the phenomenal increase in self-started companies that began during COVID, and consider those who are approaching retirement but don't really wish to retire. The startup market is competitive, and you must do your due diligence. Sources of information to assist you are available, and there will be show notes in YouTube that will give you links, including one that offers a 1-month free subscription to Capital Pulse Ratings Report, thanks to Yvan de Munck. Check it out. Is it time for you to begin investing in startups with with small investments, is it time for you to begin to think about your own startup that you have always dreamed about? Investment crowdfunding has been unlocked. I want to thank you for joining me today. I hope you have enjoyed the conversation and learned something new. And if you're on YouTube, click the like button and subscribe. Yes, it helps me, but it also helps others who are looking for similar information. I'm Madelyn Blair, wishing you infinite possibilities as you unlock your resilient leader.